You would be completely surprised at the amount of times you ask for someone to give you support for a number they have, or say why something that appears blatantly wrong is wrong, that they either can't give you support or just say, yes, it's wrong and we need to fix everything. That is where so many of these deals go, because people don't know what they don't know what to look at it before they publish it and advertise their business. Okay, everybody cares about the P&L. That's the earnings of the company. Yes, but the balance sheet really helps you make sure you're not missing things. You're doing everything correctly. That's what you really double check against. Some brokers are great, some are not so great, but they are all pretty much incentivized to close the deal. They have a lot of incentive to kind of say, oh, this is not a big deal, brush over it. Some of the procedures we do, right, is like, okay, do the bank statements reconcile out? If you skip the quality of earnings report, you just run a heightened risk that things could have gone unnoticed and missed.
Welcome to Advisory List, the SMB M&A podcast, where we sit down with advisors and professional deal makers who drive M&A transactions every day. Each week, we break down the questions buyers, sellers, and investors are actually asking: what's happening in specific markets, how to prepare for an exit, tax strategy, deal structure, and more. Whether you're an owner planning your exit, a PE group or family office sourcing deals, or an advisor trying to stay out of the market, this show is for you. I'm Gaston Reeder, host of the Advisory List podcast, and today we're getting into quality of earnings reports with someone who's guided over 500 M&A transactions. My guest today is Josh Tonnesen, the founder of Tonnesen Accounting Services, a firm that specializes in quality of earnings reports and related services for business buyers. Josh is a CPA, MBA, and began his career with prior experience in critical corporate accounting and FP&A roles at large companies including Hertz, Arthrex, and Aztec Industries. We're putting his experience to work today and discussing whether or not you need a quality of earnings report before you buy a business. Josh, welcome to the show.
Awesome. Thanks for having me.
Josh, I was excited to speak with you today because your firm is doing significant volume with quality of earnings reports. Just so we can start the conversation and give our listeners an overview of, what we're going to be talking about today, what is a quality of earnings report in plain terms?
Yeah, so quality of earnings report, typically hired by a business buyer or a company looking to sell their business. We do a financial analysis of the company. We typically will do deep dives into the profit and loss, balance sheets, compare them back to bank statements, tax returns to gain some comfort on the data, explain gaps. We will then recalculate seller's discretionary earnings or adjusted EBITDA depending on the deal size. We will typically have some management Q&A to understand some key context points to get a good, clear picture and identify errors, inconsistencies, or any other type of adjustments for the company. And then we will also document, kind of talk through working capital, show any risks, opportunities. It is worth noting that the quality of earnings product does vary provider based on provider. So some people do things a little differently than others. Some may have an expanded scope. I've seen some people out there that are basically just looking at some tax documents, not even really the financials. So it's definitely worth asking, your specific provider, kind of what they do, get some examples, and understand that thoroughly too. So.
Okay, interesting. So you're saying that not all quality of earnings reports are created equal. There's kind of different levels to getting these reports prepared.
Yep, exactly. Yep, everybody, they approach problems a different way, but also the scope is very different.
And Josh, what specifically does a QOV check for that a standard financial review, buyer's own accountant, or a bank typically wouldn't catch?
Yeah, no, that's a good question. So what everybody kind of approaches the M&A space a little different, I'd say, too, depending on what your function is. So your quality of earnings professional, they really should be in your court to help you understand the business as good as you can, right? So we are typically hired on by a buy side some engagements, sometimes a seller, but if we're on the buy side, right, trying to understand the risks and other things that they'll need to consider. Banks are typically more so trying to understand what's the DSCR, their debt service coverage ratio, and is the individual going to be able to make their loan payments? Obviously, still helpful that they don't, you don't want the new buyer to default, but if they're still getting a decent deal off of the multiple, but their earnings are down 30%, the bank won't necessarily care if their numbers flip, but it is important for the buyer to know, right? Also, people who might not be in the space and do it all the time, if your brother-in-law is an accountant, he can look at it, but accountants do very different specialized things, just like doctors, right? So if you have somebody who's not familiar with the space, he might look at it from one angle and say, "Oh, we really need to audit and call some customers and make sure that they're real and exist." Where, that might be a mechanic shop for a very small business where they don't want to give you their customer names, and it might be kind of blown out of proportion too. So we sometimes see larger accounting firms ask for people's accounting memos, right, in smaller deals where it's just a small mop and pop shop and they don't have any kind of written policy. So yeah, it kind of depends on the again the firm you're looking at for quality of earnings, but also banks will look at things differently than a broker will, than a quality of earnings provider will as well. So
It sounds comprehensive, and honestly, like you're the backstop before getting a deal done, and you want to work with someone that specializes in making sure that those earnings are real before you move forward in a deal. Can you talk to me about the increased risk someone takes on when they don't do a quality of earnings report, and perhaps give us an example of what has gone wrong when someone has skipped it?
we typically work with a lot of first time buyers, and we do work with some PE and other type groups as well. But we work with a lot of first time buyers and fully understand, right? Especially if you're not familiar with financial statements, a lot of it could get pretty overwhelming. And then you also have somebody in who is heavily incentivized, right? The broker. Some brokers are great, some are not so great, but they are all pretty much incentivized to close the deal. So they have a lot of incentive to kind of say, "Oh, this is not a big deal, brush over it." Some of procedures we do, right, is like, "Okay, do the bank statements reconcile out?" Now, the broker might say, "Look, it's a small business. That doesn't really matter. They're not getting audited. They're not a big company. There's going to be some inconsistency, sure, but you might not know that if you're again not in the space, not heavily into small business accounting, that could signify that revenue is duplicated. They might have overstated their AR and overstated their sales then, or overstated their bank balance. So if you skip the quality of earnings report, you just run a heightened risk that things could have gone unnoticed and missed. And then also, there's a whole another aspect of like working capital or other just consulting type items as well, where the quality of earnings provider should be there to assist you in a lot of these I'll call them negotiations. Like it's obviously the buyer's choice, but how much cash do you want to keep in your bank at the when you're going to acquire the business, right? It's a lot about risk levels, what's industry standard, right? And if you don't have someone in your corner, the only person who's going to be giving you some feedback typically on that is going to be the broker who just kind of wants the deal done as well. So
No, that's really interesting, especially the incentive structure, and calling out that, the deal makers that are involved in these transactions are trying to push these things closed, and having your firm or a firm like yours involved to verify can take a lot of the risk off the table. Joshua, can you talk about a deal where the quality of earnings findings changed price, terms, or led the buyer to walk?
yeah, I've got quite a few examples. One of them that comes to mind is I remember reviewing a set of financials for a company where their balance sheet, I see that they have, I think it was like 5 grand or something in sales tax liability. Then it drops to negative 40 grand the next year, negative 90 grand, negative 140 grand or whatnot. Well, the whole thing, right? You want to look at a balance sheet, you want to make sure it's reasonable. There's this huge gap for whatever reason in small business. Even bookkeepers do it sometimes where they just think, okay, everybody cares about the P&L. That's the earnings of the company. Yes, but the balance sheet really helps you make sure you're not missing things. You're doing everything correctly. That's what you really double check against. So they did not follow those right procedures. Their tax preparer prepared their tax returns incorrectly, or maybe correctly off of incorrect data. I don't know. But basically, what happened is that they missed sales tax expenses of 50 grand per year off of a deal that maybe was making like 250 or 300 a year, which is obviously a very, very, very big, meaningful part of the business, right? Kind of going back to the earlier point on the banks, they rely heavily on tax returns. So the tax returns actually were showing enough cash flow for the business. Sure, some banks are great, some of them aren't. And even in the banks, you have some guys that might know accounting and other guys that might not. So it really kind of varies in that. But the fact is I've heard banks tell me like, hey, I'm just going to accept whatever's on the tax return as long as because that's what the SBA requires. And then we can underwrite. It's not my job to say, is that right or wrong? So that's really a perfect example of one that we looked at and we're like, okay, the earnings are really lower by 20, 30% or so that our client was able to go ahead, get a more favorable price on. And it's an honest, still more honest price, I guess I'd say, where it wasn't intentional by the company. They actually overpaid on taxes. So it's kind of bittersweet for them. They lose money, sure, but now they get to refile taxes and get some money back from the IRS. So Yeah, I mean, that's just one example. Happy to give as many as you like.
No, that's incredible. So in that case, the buyer was actually able to retrade for a more fair price, and the deal was still able to move forward.
Yeah, yeah, that is an example. A lot of times, especially when the deals are smaller, the question for the buyer then becomes, well, if they're making instead of 300, 250 or 250 versus 200 or whatever it is, well, do I still want to quit my job then, right? You just lost. And then there's also a theory of like multiple decay. Okay, it's a smaller deal. Should I pay the same multiple, right? And it's a very emotional thing. Many people are already heavily emotionally invested to buy the business at that point too. So a lot of times people will say, okay, I'm down 10 or 20% on the earnings. I'm going to go and take that same percentage off the purchase price. And then, like anything else, right, it's just you have to find the right strike price between what the seller will sell for and the buyer will buy for. And the numbers are what they are. So,
Sure, absolutely. So a lot of times, a quality of earnings report coming back with anomalies doesn't result in the deal dying, but could often result in the retrade.
exactly. Yeah. And it's just funny because sometimes you have clients that really want you to just slice and dice everything and make it like they want you to find material findings. And obviously, we try to find the most honest picture of the business, right? And it's the um, the fact is, like, if at least the way I would look at it, if I'm buying a business, I want the earnings that they stated. That's my whole assumption on I would like that to be true and accurate. If you have a decrease in that, yeah, the price should go down, but now your actual future earnings are down too, right? So it's a lot of times people are willing to accept that, go and retrade, but sometimes people just say, no, it's not worth it. I'm going to find another target that's more where I want it to be in terms of earnings. So
So, Josh, how do you verify add backs as it relates to sellers' discretionary expenses?
one of the main principles that I'd say, but I'm gonna put an asterisk on this, is that the add backs you should be able to find on the P&L, and they should only be P&L accounts. Now, why is there an asterisk? Because over all the reports I've seen, people do things wrong in their own way all the time. If you look at a sim, you might see them adding back owner distributions. That's not correct. That's a cash flow item, but sometimes people incorrectly book owner distributions as an expense on their P&L, right? So then that's why you kind of really have to go and be very detailed and look at the account level stuff and make sure that, okay, we are adding back. The whole concept of add backs could get people stumped a little bit, but the concept is that you want to neutralize the impact of it. So there's something on your profit and loss, right, which is the money you earned versus the money that you incur, the expenses you've incurred to get your profit. You want to add it back to say it basically never existed, like an officer salary, right? You want to add it back. So the reason that context is important is because if they have distributions on their P&L, we add them back to eliminate the reduction in profit that was recorded as a result of them. Now, you see vehicle loans. Sometimes I see vehicle loans on the P&L, but it should be on the balance sheet. Vast majority of times it is. So they shouldn't be adding it back. People get tripped up because they think, oh, that's cash flow. It's cash coming out. Yes, but it did not reduce your profit. So it gets a little technical there. So how do we validate the add backs? First, making sure they exist and are appropriate on the P&L. Second, we might have some error corrections that don't exist there, maybe converting from cash to an accrual basis. But third, like really third and part of kind of point one, two is the going to the right level of detail on it. So there's different buckets, just to name a few of add backs that I've kind of grouped things in my head. There's some that very easy cut and dry. Owner's salary, you can find a W-2, you can find that on the tax returns typically, depending on how they file. You can add that back with a high level of comfort that, yes, you have the right number. However, if you are looking for something like travel, meals, and entertainment, sometimes clients say, oh, can we get the receipts? I can get the McDonald's receipts, sure, but I have no idea if they took their kid or if they took their coworkers there every Wednesday, right? So it's like the receipts still
Sure.
don't get it. So some of these, which is what brokers do, some do it better than most, is that you'll add the full expense back and then you'll recast what's a reasonable amount that the business will occur in their meals, travel, and entertainment every year, right? So another thing, related party stuff, right? What's your post-close rent expense? Having a professional there just helps you make sure you're not forgetting the triple net type impacts, the CAM, real estate taxes, insurance type things too. So, my really main thing, add backs, make sure they exist, make sure you're going to the right level of detail. You're not adding back too much or doing the right appropriate level of diligence around them and that everything is supported like it should be. So
Okay, perfect. And so your different buckets of add backs deserve different levels of scrutiny or different processes is kind of what you're saying.
exactly. Yep, yep. Some of it is estimates, like, if they had 40 grand per year in meals expense and they are a one-man shop, it's just the owner, well, you probably don't need that, right? It's just kind of being reasonable, and banks may or may not accept it. They have their own rules that they'll do. Again, kind of differs on the bank, but the thing is you want to go as detailed as possible on it. It's a huge decision you're making typically. And then another one is like cash sales people come up with sometimes. There's no good way to verify how much cash they got. I feel as if sometimes people think, "Oh, the QOE guy's gonna know how much cash they got." I'm like, I have no idea how much cash they have in their drawer at home. Like, there's no way for me to tell that, right? So, sometimes it's usually you want to be on the conservative end and not accept them. They might give you point of sales. That's easy to do fraudulent stuff on too. So we don't usually put that as a high weight thing, but your QE provider should be able to show you what if scenarios and model it out and document it all appropriately and accordingly too. So
That makes a lot of sense. That makes a lot of sense. So there's a discussion to be had after the report is created about any issues that might deserve additional clarity or a revisit.
yeah, and again, I'll say it varies on provider. I can't speak for like the whole community. Obviously, I know a lot of them are good and will sit on calls like we sit on calls with our clients because a lot of the stuff could be judgmental. So you definitely want to make sure that they not only see the numbers, they know what the numbers mean, they're comfortable with it. And if okay, look, the company told you X, but actually the client might know Y from their site visit and other things, right? So it helps you align, make sure you're getting the most accurate picture possible, and then really opens the door for any questions or rather kind of pressing in further on certain things. So
So, Josh, have you noticed any patterns to which businesses show the biggest gap between reported and real earnings, industry, owner involvement, revenue range, et cetera?
So, just in terms of patterns, I'll say like typically the bigger a company gets, the more built out their financial accounting systems tend to be too. So they might have an in-house accountant and things of that nature. That being said, I've seen companies make $1 million a year, and that one actually that I'm thinking of now did their accounting manually on general ledger like physical paper. Like it was crazy, right? So it's
Wow.
there's a wide variety and exceptions to the rule, but generally the larger a company gets, the more built out their accounting functions are. Small businesses typically do lack some like good controllership stuff, so their books could still be wrong. The pattern is right, the more sophisticated the company is, I'd say from their accounting perspective, it's generally a little bit better. Sometimes you get good sophisticated accounting, and then the broker comes in and does some silly stuff on top, so you still never really know kind of what happens. But yeah, if there's a CPA firm, I would say that gives me a little more comfort in the numbers, although we catch errors like that all the time. Sometimes they know how to present certain numbers too. I do have one example where we were looking at, I don't know if it was a CPA firm and an accounting firm, one of the two, but the owner said, well, I didn't work too much, but if I worked more, the business could have made X dollars. So it's like they went and they added something back that was completely non existent, right? So definitely still have caution on everything. But yeah, if there's a CPA firm, it's definitely a step up on a bookkeeping firm. And in all honesty, I think bookkeeping firms are generally just as good as owners sometimes on their own books. The owners, if they're very organized, they can do a great job record keeping. So it's tough for me to say is there a great pattern on like revenue size. Yeah, it gets typically better as you go up a little bit, but there's always exceptions to the rule. There are some industry standard things that we do watch out for. Like, for example, usually on accounting firms, customer churn is something that people will care a lot more about in the quality of the quality of earnings report. Another thing with like construction type businesses where they have longer contracts, there's a concept called WIP, the work in progress, that is supposed to help you match your revenue and your expenses appropriately. Most businesses, even as you get a little bit larger, like 10 million still, might not be doing their WIP reports, which does not properly match revenue and expenses and can distort your earnings. So there's ways around it that your quality of earnings provider should look at multiple years, understand the story between the time periods. That helps alleviate some of that risk, but it's still best to get some kind of WIP reporting. It's fairly tedious for a company to do that, so they don't always do that, and it's some of these things are kinda as good as data as they're willing to give, and they just say, kinda make your decision or not. Maybe you get a risk discount, I don't know, but in terms of industry specific stuff, there's definitely things to consider that are more just risks. So, revenue recognition on longer term contracts where your cash versus accrual gap, getting revenue, or I should say, getting the cash versus earning the revenue could have a gap. And same with incurring expenses versus paying the expenses. That's your cash versus accrual gap. That will cause bigger risks around the reported earnings. Then, yeah, a lot of customer type, industry stuff will come up from time to time as well. And sometimes fixed assets could also be a bigger thing. That's more operational too. But if it's a heavy equipment type industry too, you definitely want to diligence that a little bit more as well. Something else comes up sometimes on those industries is capital expenditures. Sometimes people get confused that SDE or adjusted EBITDA is not the cash they're walking away with. So keep in mind your industry that you're working with as well, that you may not walk away with that on an accounting firm. Sure, you're not going to have to buy a bunch of equipment, but on some kind of farming company or something, right? You're going to have to buy a lot of machinery from time to time. Well, you might not be walking away with that cash and it could impact your cash flow too. So it's, yeah, industry specific kind of matters on what you're looking at, how you approach the problem. Not super impactful on like what's the typical gap we'll see though. So
Sure, sure. So there's some industry specific markers, or if you're walking into a specific type of company, you may know that you have to look at some items a little bit more thoroughly than others. But as a general pattern, the level of professionals the selling company has employed is oftentimes a marker between reported and real earnings.
yep. No, I agree. And also I do feel bad for business owners sometimes because the
Sure.
level of quality from one CPA firm to another or one bookkeeping firm to another is so vast and so different. So it's tough to say universal. I'd say yeah, it's a pattern, but it's I crazy
Yeah.
things random CPAs will do, and I just know the business owner has no way of knowing that, and they screwed everything up. So yep.
I was going to ask that, whether, if you get a business owner that has, a top 10 accounting firm, PricewaterhouseCooper, versus someone you've never heard of, if, that changes the answer there.
Yeah, I did review I think they were doing I don't know if it was a compilation or something, but something from KPMG once, which everybody makes mistakes, not saying that, but like there was an error on something where they missed a whole month of one of the years accidentally. So when they did their full year, stuff was off. So it's like sometimes with the bigger companies, they don't always put their best and brightest on the smaller deals too, right? So you never really know on some of them what you're getting, but also, the scope is different. Sometimes you have really good tax guys who have no idea what they're doing with financials, and we found that to be a huge issue where it's not like in their lane. Yeah, they say I have a really good reputable New York City accounting firm who does our taxes, but their financials they were showing 300K of earnings plus or minus like 300K basically because they messed up the balance sheet. So yeah, it's tough. Some firms are better than others. Scope matters, and things are all over the place is kinda where I'm at, so
Sure, sure. And so that's why we bring you in if you're buying a company, right?
yep.
Talking about just the practical aspects, if I'm buying a business, what's the cost and turnaround time for you to do a lower middle market deal?
Yeah, so for us, I'll talk about us personally, and then I can just kind of give some my opinion on the market, I guess, as a whole. So my firm, we charge 7,500 for SBA size deals. Now, when we do larger deals, which we do, we might have some incremental price increases depending on complexity and things like that. We do have two other upcharges that are applicable for all of our deals as well. That are, I'd argue, out of scope items. I just bring up on our calls too, but sometimes we'll redo their financials from scratch if they don't have bookkeeping records and they have bank statements and tax returns. My firm can do their bookkeeping, but it's a lot of extra work to do bookkeeping and then a QOE report. And so we could do all that, or on the sell side too. We're happy to do that as well. And then also we price them out per business. Sometimes we have people buying a package deal of five completely different restaurants from five different sellers. It's really five times the amount of work. So I know a lot of other competitors out there, they price every single engagement out differently. For me, I'm just like, I never know what I'm getting into sometimes with these. So I just figure it's kind of easier to be simpler on my end. And we do a good amount of volume, so it's much simpler for me than to kind of remember all the proposals and stuff out there. And then but yeah, we charge 7,500 for that, pretty much flat fee, start to finish on that. And then I'd say in the general market, there's people who are definitely cheaper than us, people who are definitely more expensive. Just general recommendation out there. There's companies like Advisory List here that has them all there, and you can always just look at their ratings, Google review ratings, other platforms as well, understanding what people have said in the past. But I always think a good warm referral from somebody else that you know personally in the space goes a long way, where they can give you specifics on things they liked or wish maybe that they would do different. And I would highly recommend, obviously, getting on a call and talking with the potential provider, but getting an example of their product at the end. I do walk everybody through what we do because I'd like to make sure there's no questions on scope, more or less, which we don't really have a lot of pushback on it. But sometimes people people have engaged firms, I'd say, and it's like, "Oh, you don't look at this, you're not diving into this," so getting that addressed up front will also impact pricing and also make sure that everybody's kind of on the same page before they pay the fee, so
Absolutely. No, incredible. That's very helpful. And so if I'm a buyer and I'm walking into my search for an acquisition opportunity, at what point in the deal process should I be looking to line up my quality of earnings provider?
So the typical point you'll engage your quality of earnings provider is a couple days after going under LOI. And I know that's not the question, but I'll get back to it. But you usually will engage them a couple days after going under LOI. You could do it right away if you feel very good you're going to buy the business. But sometimes it's nice to do a site visit or to review the customer list first or whatever you want to do before you pay the fee. That way you don't end up paying for something that isn't beneficial to you in any way, right? A lot of providers like us will offer some kind of, they call it like a broken deal fee. We do it off of work that we've done rather than if your deal closes or not, because we do the work still and it's a weird incentive, but everybody again does it different. Some do phased approaches and stuff. But the reason I'm saying that is because when do you want to engage them? You want to engage a couple days after under LOI, but when do you want to start networking with them? Kind of whenever. Like I used to post more on LinkedIn. I just haven't been able to recently. A lot of other my competitors do it. You can kind of see what they do, what their thoughts are on things from time to time. Obviously, you could reach out to me, and if you have some weird questions on your deal or whatever, happy to help in any way I can. You can always start to network early, but sometimes it's best to have your specific deal in mind when you're talking to somebody about a quality branding, so that way you could bring anything specific to them on the deal, confirm scope all at the same time, and then you'll have 2 or 3 of them fresh in your mind or however many you want to interview. That way, when you're making that decision, you have the most relevant information at your hands there, so
Doesn't hurt to line up your network early, but a couple days after you sign the LOI, that's typically the time to begin engagement.
Yep, exactly, yep.
And Josh, are there any times when you don't need a quality of earnings report on a deal?
So it's really when you don't care about the earnings, right? So it's or when you don't need somebody in your on your side, I'd say with some of them too. So quality of earnings, there's a lot of things we do to make sure that we feel comfortable with the reported numbers and everything's calculated correctly. We also help with working capital. That's another thing. It's relevant 100%, but at the same time, like you don't want to say, okay, they calculated everything correct, but then find out you didn't have enough money to start, even if the company wasn't providing it. So there's a lot of other, I'll say, consulting type services or like guidance. Like people find other things very, very helpful, just opportunities and risks the provider may see. So there's a lot of reasons outside of the earnings, but in reality, if the earnings are not as important for you, that maybe sometime you could skip it. For an example, right? My firm, we do mostly quality of earnings work. We have a very, very small like set of bookkeeping clients that we manage, just really happy customers in the past that they needed help after close. And I could go ahead and buy another bookkeeping firm. Do I care too much about their expenses? I mean, kind of, but I know what it would cost us to do it, right? The work. We have our process in place and everything. So I'm really buying a customer list at that point. And that's why accounting firms, they might trade off of earnings of STE or adjusted EBITDA, but a lot of them trade off of revenue for that reason too, because you're buying the revenue, you're buying the customer list, right? So if you're not caring about the earnings, you're just caring about something else like the revenue or the customers, just due diligence that. I mean, the QOE guy can do that too, right? But if you just want to see their customers and you want to say, okay, you had 100 customers last year and 10 of them were new and 10, dropped off. Maybe you're buying a list of 90 guys for this year plus whatever you advertise or so. So that you can do some of that stuff on your own if earnings aren't important for you or there's maybe something else strategic or specific you're looking at that's not necessarily just purely numbers driven. Or if everything is seller finance, sometimes if you have this risk that's not really on you, but even with seller finance, or we've even done deals where people are getting the business for free and it wasn't making money because of all the insights we typically give. So it's really kind of dependent on the person, what they want to get out of it, but also what's important to them. So
And does having reviewed or audited financials change anything about being buying a specific transaction and whether or not you would employ additional scrutiny to the financials?
so I like to think my opinion is somewhat common around everybody, but I don't know. I don't have a great opinion on terms of what the audited and reviewed financials are from most firms out there. The reason for that is because Audit and other attestation work, which quality of earnings is not, are things where an accountant is saying, yes, this is true. I have verified it to a certain agreed upon set of standards by the accounting boards. And that if they did something wrong or whatever, they're also on the line and on the hook for stuff. So the reason I'm saying that is think of it logically, right? If you're on the hook and you're saying this stuff, you're doing super high level numbers. That way, if something's wrong between different buckets, right, it's very unlikely if you just did one huge bucket with everything included. So and they just do full year numbers. So if you're just doing full year numbers, you're basically never, unless it's at the very end of the year, going to have a trailing 12-month view of anything. And by the time you get your audit done, you're already 3 or 4 months into the next year, right? So it's it creates this still big data gap. So I'll kind of talk about what we do, I guess, real quick on that is we use the company source bookkeeping data as our real source for our report. Then we bridge it back to bank statements to get comfortable with how they do their bookkeeping and obviously identify errors. And then we will take that source bookkeeping, compare it back over to tax returns, because that's what they use for the tax returns and SBA will use for their underwriting. And then we will also bridge it to any other documents that are relevant, like the SIM, audited financials, whatever else might be out there to understand the gaps. Because sometimes their accountant might make an accrual adjustment that we can go ahead and use and will give us a better picture, sure. But sometimes there's just a whole bunch of other nonsense that goes on that needs to be removed. And then one other part that is important also is that the it might be a little technical, but GAAP, generally accepted accounting principles, is what audited financial statements are meant to represent. They will show the officer's salary included in there and part of wages. It doesn't give you the non-GAAP, the not generally accepted accounting principles numbers that are going to show you
Sure.
the actual earnings that you would most likely use in your valuation, right? So it is a different scope, a different process, and it doesn't get you some banks like reviewed or audited, like it's a kind of a bank thing. I personally think I have some issues with how the banks do things from time to time, but regardless, what they so the banks do like that. But from a comfort perspective, if I was personally going to look at buying a company, and I know I'm a detailed person, but I would look at their financials, compare to bank statements, tax returns, the audited financial statements. Okay, great, someone else signed off on it, but it's a different number than I normally care about too. And I'm going to want to make sure I can bridge that gap to get to a good spot that I want to be in for my decision making.
Absolutely. No, that makes a lot of sense. And again, I've said this before on this episode, but it sounds incredibly comprehensive what you do. And my last question is, if a buyer does nothing else in diligence, what's the one thing from a Q of E they should never skip?
So, and this is just general accounting, I would say, guidance that people miss, and look at the balance sheet and see is everything reasonable? Is everything there? The example I gave earlier, where sales tax was put on the balance sheet. Well, if somebody looked at the balance, even before you pay my fee, this is why I show everything that we do before someone hires us, because that way they know, like, you guys can do it before you pay me to do it perfectly fine. You'll find issues, right? But you don't always have the accounting expertise and guidance on it, which is why you pay me. But yeah, if you find this and you're like, it doesn't make any sense, you have negative 50 or 200K or whatever on your balance sheet. Yes, that is something that very well could end up hurting the profitability of the company. So it's just take a detailed review of their balance sheet and then also just sniff test the P&L. Is this reasonable? Anything that does not seem reasonable, ask. That's what I'm going to do, right? If you would be completely surprised at the amount of times you ask for someone to give you support for a number they have, or say why something that appears blatantly wrong is wrong, that they either can't give you support or just say, yes, it's wrong and we need to fix everything. That is where so many of these deals go, because people don't know what to look at it before they publish it and advertise their business.
So Josh, this has been great. If I'm a buyer and I come to Tonnesen Accounting, then what I know on my deal is I'm walking away with peace of mind, knowing somebody's double checking and triple checking all of the work and making sure the deal that I'm moving forward with is as stated. Incredible resource having you on the show. Really appreciate it. Where can people find you?
Yeah, so you can find me on LinkedIn. Feel free to connect with me, shoot me a message there. Also my website, Tonnesen Accounting Services. There's a contact form there. You can email Josh at Tonnesen Accounting Services as well. I made my email. I did not realize how long that would be, so apologies. But yeah, any of those work. And then, yeah, anything I can do to help, let me know. So
Amazing. Well, thanks so much for being on the show. That's it for this episode of Advisory List. If you're a buyer, seller, or advisor in the space, head to advisorylist.co to explore the directory, join the community, or get matched with the right advisor for your deal. New episodes drop weekly. See you next time.